Good day, gentlemen. Welcome back to Accounting 429 Financial Statement Analysis course. This is your instructor, Mohammed Aljaber, and today we're going to look at Chapter 6, which focuses on understanding cash flow statements. So let us go to the following slide so we can take a look together at the learning outcomes for today's lecture. So as you can see in today's lecture, broadly speaking, we're going to look at an overview of the statement of cash flows. We're going to see how the formatting is done for statement of cash flows, how can we prepare a statement of cash flow, and we'll take a look at some additional analytical considerations when we talk about statements of cash flows. To be more specific, there's a few considerations that we're going to look into. So we want to compare cash flows from operating, investing, and financing activities and classify cash flow items as relating to one of those three categories, given a description of the items. We also want to describe how non-cash investing and financing activities are reported. Contrast cash flow statements prepared under International Financial Reporting Standards, the IFRS, and the U.S. Generally Accepted Accounting Principles, GAAP. We also want to distinguish between the direct and indirect methods of presenting cash from operating activities and describe the arguments in favor of each method. Describe how the cash flow statements is linked to the income statement and the balance sheet that we have covered in previous chapters. Describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows can be computed using income statement and balance sheet data. We also want to convert cash flows from the indirect to direct method, analyze and interpret both reported and common size cash flow statements, and finally calculate and interpret free cash flow to the firm, free cash flow to equity, and performance and coverage cash flow ratios. Broadly speaking, the cash flow statement provides information about a company's cash receipts and cash payments during an accounting period. Looking at the bottom of the statement of cash flows, we can easily see the increase or decrease in cash and cash equivalents for each year for the company. So in this example we have here for Colgate-Palmolive Company, we can see that the increase in cash in millions was 388 million for 2011. There was a decrease of 110 million for 2010 and a 45 million increase in 2009. An overall 323 million net increase in cash over 3 years, from 555 million at the beginning of 2009 to 878 million at the end of 2011. In general, what are the implications of too little cash or having too much cash? We will see that further in our discussion. As a basis for comparison and relating to the question of how much cash is enough or too much on the previous slide, this slide shows the statement of cash flows for Apple Incorporation. In 2010, for example, Apple's cash and cash equivalents increased by 6 billion to 11.3 billion. Apple generated 18.6 billion from operating activities and needed only around 3 billion for expenditures on PP&E, which from our previous study we know it's property, plant and equipment, and for intangible assets and acquisitions. Apple paid no dividends. This was a common practice for Apple over the previous decades, where they did not pay any dividends to their investors up until recently, a few years back. So even after the 11 billion of net purchases of marketable securities, um, their net purchases were 57,793 billion and 24,830 billion from maturities. The company still had a significant increase in cash and cash equivalents over the financial period covered in the statements. In this slide, we can see a list of the three categories of cash flows. So we have operating, investing, and financing activities. So cash flows can be generated or spent, or one of these three categories. So for operating activities, this relates to the delivery or production of goods, or for services provided to customers. So examples of that would be receiving cash from customers for a certain product, paying cash to suppliers, or paying cash for operating expenses. The second category is investing activities, and this relates to buying or selling long-term assets and other investments. Examples of that would be PP&E, we talked about before, which is property, plant, and equipment. So the investment in one of these assets or long-term assets would be considered an investing activity. Other companies' securities, so that are not cash equivalents, also is an example of investing activity. And the third and last category would be financing activities, which relates to obtaining or repaying capital. So examples of that would be borrowing from creditors and repaying the principal, issuing or repurchases of stocks, and the payment of dividends to investors. Here we go back to Colgate. We can see that Colgate consistently obtains its cash inflow from operating activities, while on the other hand uses cash in investing and financing activities. This profile shows a positive overall cash flow and is fairly typical for a mature company such as Colgate. Cash generated in operations is used to make investments for the future and also to repay capital providers. In contrast, a startup company would obtain cash from financing activities and use the cash to make investments for the future. A startup company might not have positive cash flow from operations immediately in the early stages of that company. Now here we take a closer look at the operating activities section of Colgate's statement of cash flows. And what I would suggest when looking at a such statement is that rather than spending too much time on individual reconciling items, you need to first focus on the overall relationship between net income and operating cash flows. So over the long term, for a mature company, operating cash flows should exceed net income. And if a company has rising net income and falling cash flow, it can be a red flag. So for example, it might signal potential problems, a problem in collecting accounts receivable, for example. However, such a pattern could occur naturally in the early years of a business. Now, how does Colgate's operating cash flow compare with its net income over the 3 years? It exceeds it in every year. So net cash from operations decreased in 2011 compared to with 2010, and the company's MD&A, management discussion and analysis, explains that net cash provided by operations in 2011 was 2,896 as compared with 3,211 in 2010 and 3,277 in 2009. And the decrease in 2011 as compared to 2010 was primarily due to an increase in voluntary benefit plan contributions. Here in this slide we take a closer look at the investing activities section of Colgate's statement of cash flows. The slide also includes the amount of cash provided by operations. So in every year, Colgate's cash from operations was more than enough to cover its capital expenditures. In 2011, the amounts were cash from operations of 2,896 million and capital expenditures of 537 million. Investing activities used 1,213 million in 2011 compared with 658 million and 841 million during 2010 and 2009 respectively. In its MD&A, Colgate says the increase was primarily because of the purchase of the Cenex business for 966 million and refer to the item payments for acquisitions net of cash acquired. Colgate also discloses that the Cenex acquisitions was funded in part by proceeds from the sale of the company's euro-denominated investment portfolio. You can see that in the item proceeds from sales of marketable securities and investments, which is greater than purchases of marketable securities and investments in 2011. And finally, Colgate also discloses in their MD&A that the purchase price was partially offset by the sale of the company's laundry detergent business in Colombia for 215 million and the receipt of the first installment of 24 million from the sale of a Mexico City site. Lastly, in this slide we take a closer look at the financing activities section of Colgate's statement of cash flows. The financing activities used 1,242 million of cash during 2011, much less than the 2,624 million and 2,270 million during 2010 and 2009 respectively. There are two reasons behind the big difference. First, the company had higher net proceeds from the issuance of debt. The proceeds from debt issuance in 2011 were 5,843 million compared with principal payments of debt of 4,429 million. Second, the company had a lower level of share repurchases. The amount of share repurchases were 1,806 million in 2011 versus 2,020 million in 2010. The amount of dividends paid has steadily increased over the past 3 years. Referring to amounts from previous slides, it can be noted that the amounts of operating cash after paying for capital expenditure, 2,359 million, was more than enough to cover the dividend payments of 1,203 million. Now, if you could recall in our discussion of income statements, we said that a common size analysis of a company's income statement, each income and expense line item is expressed as a percentage of net revenue or net sales. On the other hand, for balance sheets or in the common size balance sheet, each asset, liability and equity line item is expressed as a percentage of total assets. For the common size cash flow statement, however, there are two alternative approaches. So we could express each line item as a percentage of net revenue, or we could express each line item of cash inflow or outflow as a percentage of total inflows or outflows of cash. So you can see in this slide how each category of Colgate's statements of cash flow presented as a percentage of net revenues. So the operating cash flows are consistently close to 20% of net revenue, although 2011 is somewhat lower. The investing cash flows as an absolute percentage of net revenues are higher in 2011 than in previous years. And as discussed, this mainly reflects the Cenex acquisition they had in 2011. And financing cash flows as an absolute percentage of net revenues are also lower in 2011 than in previous years. This is due mainly to reflect the net debt proceeds and the lower amount of share repurchases carried out on that year. Now, based on our previous discussion, we can formulate a summary of Colgate's cash flows, and in that summary, we can conclude that overall 323 million net increase in cash over 3 years, from 555 million at the beginning of 2009 to 878 million at the end of 2011. Colgate consistently obtains its cash inflows from operating activities and uses cash in investing and financing activities, which is a typical profile for a mature company. Colgate's operating cash flow exceeds net income in every year, which is a desirable profile for a mature company. And in every year, Colgate's cash from operations was more than enough to cover its capital expenditures, which is a good sign. Also, the amount of dividends paid has steadily increased over the past 3 years. Again, this provides a positive signal or a positive indicator for investors. Also, the amount of operating cash after paying for capital expenditures was more than enough to cover the dividend payments. And finally, this can conclude that Colgate's cash flows represent a positive overall profile for the company. In general, there are two acceptable formats for reporting cash flow from operating activities, also known as cash flow from operations or operating cash flow, defined as the net amount of cash provided from operating activities, which is basically the direct and the indirect methods. The amount of operating cash flow is identical under both methods, only the presentation format of the operating cash flow section will differ. The presentation format of the cash flows from investing and financing activities is exactly the same, regardless of which method is used to represent operating cash flows. Colgate's statement is an example of the indirect method of presenting operating activities. It is indirect because it starts with net income and then undoes accrual accounting and reclassifies certain amounts to get back to cash provided by operations. The net income number in the indirect method links to the income statement. Now, rather than spending too much time on individual reconciling items here, first focus on the overall relationship between net income and operating cash flows. Over the long term, for a mature company such as Colgate, operating cash flows should exceed net income. If a company has rising net income and falling cash flow, it can be a red flag, as we discussed before. Now, how does Colgate's operating cash compare with its net income over the 3 years? Does it exceed it in every year, or it does not? I'll leave the judgment for you. So let us try to compare between the indirect and the direct methods. The indirect method shows how cash flow from operations can be obtained from reported net income as the result of a series of adjustments. The indirect format begins with net income. To reconcile net income with operating cash flow, adjustments are made for non-cash items, for non-operating items, and for the net changes in operating accruals. The main argument for the indirect approach is that it shows the reasons for differences between net income and operating cash flows. Another argument for the indirect method is that it mirrors a forecasting approach that begins by forecasting future income and then derives cash flows by adjusting for changes in balance sheet amounts or balance sheet accounts that occur because of the timing differences between accrual and cash accounting. The direct method, on the other hand, shows the specific cash inflows and outflows that result in reported cash flow from operating activities. The direct method shows each cash inflow and outflow related to a company's cash receipts and disbursements. In other words, the direct method eliminates any impact of accruals and shows only cash receipts and cash payments. The primary argument here in favor of the direct method is that it provides information on the specific sources of operating cash receipts and payments. This is in contrast to the indirect method, which shows only the net result of these receipts and payments. Just as information on the specific sources of revenue and expenses is more useful than knowing only the net results, in this case the net income. So the analyst gets additional information from a direct format cash flow statement. The additional information is useful in understanding historical performance and in predicting future operating cash flows. Now, under IFRS and US GAAP, we can see that both standards encourage the use of the direct method, but permit either method. US GAAP encourage the use of the direct method, but also require companies to present a reconciliation between net income and cash flow, which is equivalent to the indirect method. If the indirect method is chosen, no direct format disclosures are required. The majority of companies reporting under IFRS or the US GAAP present using the indirect method for operating cash flows. Here we can take a look at a direct method cash flow statement. This is the Tech Data's statement of cash flows. We using this as an example of the direct method of presenting operating activities. Now, it is called direct because it does not start with the net income, rather it just shows cash collected from clients right away. Tech Data is a US GAAP reporting company, and note that US GAAP require interest paid to be presented in operating activities, whereas IFRS permit companies to choose whether to present interest paid in operating or in financing. And in the next slide, we can see a summary of the differences in categorization. So this slide summarizes the key differences for classification of cash flows between IFRS and US GAAP. Most significantly, IFRS allow more flexibility in the reporting of such items as interest paid or received and dividends paid or received, and in how income tax expense is classified. US GAAP classify interest and dividends received from investments as operating activities. IFRS allow companies to classify interest and dividends received from investments as either operating or investment cash flows. US GAAP classify interest expense as an operating activity, even though the principal amount of the debt issued is classified as a financing activity, whereas the IFRS allow companies to classify interest expense as either an operating activity or a financing activity. GAAP classify dividends paid to stockholders as a financing activity. IFRS allow companies to classify dividends paid as either an operating activity or a financing activity. And finally, the US GAAP classify all income tax expenses as an operating activity, where the IFRS also classify income tax expense as an operating activity unless the tax expense can be specifically identified with an investing or financing activity, such as the tax effect of the sale of a discontinued operation could be classified under investing activity. Here we have Portugal Telecom's statement of cash flows as an example of the direct method of presenting operating activities. Now remember, again, it is called direct because it does not start with net income, rather it just shows cash collected from clients. Now for Portugal Telecom statement, we can see that it illustrates the requirement that cash flow from continued and discontinued operations be presented separately. Portugal Telecom is an IFRS reporting company, and unlike US GAAP, IFRS does not require the company to report interest received and paid in the operating section of the statement of cash flows. Portugal Telecom's investing is a company that follows generally accepted accounting principles, and as we noted earlier that GAAP classify interest, dividends, or interest and dividends received from investments as operating activities. On the other hand, the IFRS allow companies to classify interest and dividends received from investments as either operating or investment or investing cash flows. And this excerpt in front of you is from Portugal Telecom statement of cash flows, and it shows the choice to report interest income and dividends received as received in investing activities. Now, investing cash flows from continuing and discontinued operations are presented separately but not shown here to make the slide more readable. Now, in this snapshot from Portugal Telecom's statement of cash flows, it shows the choice to report interest expense in financing activities. And as we noted earlier, US GAAP classify interest expense as an operating activity, even though the principal amount of the debt issued is classified as financing activity. In contrast with IFRS, the IFRS allow companies to classify interest expense as either an operating activity or a financing activity. Now, companies may also engage in non-cash investing and financing transactions. A non-cash transaction is any transaction that does not involve an inflow or outflow of cash. For example, if a company exchanges one non-monetary asset for another non-monetary asset, so no cash is involved in this transaction. Similarly, no cash is involved when a company issues common stock, either for dividends or in connection with conversion of a convertible bond or convertible preferred stock. And because there's no cash involved in a non-cash transaction, by definition, these transactions are not incorporated in the cash flow statement. However, because such transactions may affect a company's capital or asset structures, any significant non-cash transaction is required to be disclosed, either in a separate note or a supplementary schedule to the cash flow statement. Let us quickly recap the Colgate-Palmolive Company's statement of cash flow that we covered at the beginning of this lecture. From this, we want to see how the amount of cash at the beginning and at the end of the year links directly to the balance sheet. So keep the figures and the amounts reflected here in this statement of cash flow in mind when we take a look at the following slide. Now, this slide shows the bottom few lines of Colgate's statement of cash flows that we covered in the previous slide, and the top line of Colgate's balance sheet. So the amount of cash at the beginning and at the end of the year directly links to the balance sheet, as you can see right here. The amount of 490 million was Colgate's cash balance at the end of 2010, which of course is also its cash balance at the beginning of 2011. Now, here we want to illustrate the steps that are followed in order to prepare a statement of cash flow. So first, you begin in the first step by determining the change in cash that occurred during the financial period, and then you can determine the net cash flow from operating activities. So you can use both the current year's income statement and information on current assets and liabilities from the comparative balance sheets in order to figure out what was your operating activities or your cash from operating activities. The third step would be to determine the net cash flows from investing and financing activities. So you can examine all other changes in the balance sheet accounts to figure out what are the changes that occurred in cash flows relating to investing and financing activities during the financial period. And the fourth step would be to summarize the net increase or decrease in cash. So deciding the cash at the beginning and cash at the end of the financial period. And finally, step number 5 is to disclose any significant non-cash transactions separately at the bottom of these statements. Now let's look at an example. This is an imaginary company uh, with its details listed in front of you. So this is a new company that has the following transactions. It sells stock for $100, buys a building for $50. Its primary line of business is selling a service, so that means they will have no cost of goods sold and no inventory. It makes credit sales of $100 and subsequently collects $90. Accrues selling, general, and administrative expenses of $40 and subsequently pays cash of $25. It also recorded a depreciation expense of $10. So let's follow the framework that we just illustrated in the previous slide to try and create a cash flow statement for this company. So the first step we want to perform is to determine the change in cash. Since this is a new company, so the beginning balance for cash is $0. Well, basically the beginning balance for all of the accounts is actually zero balance. The company sells stock for $100, increasing cash by $100 and common stock by $100. It purchased a building for $50, so its primary line of business, as we discussed, is selling services, so we don't have any cost of goods sold or inventory. It decreased cash by $50 and increased building assets by $50. It makes credit sales of $100 and subsequently collects $90. This is what we got from the example. So it increased cash by $90, accounts receivable by $10, and which is the remaining for the 100, and also retained earnings by $100. It accrues a SG&A expense of $40 and subsequently pays cash of $25. So it decreased cash by $25, decreased retained earnings by $40, and increased accounts payable by $15. It records a depreciation expense of $10, so it decreased retained earnings by $10 and increased accumulated depreciation, which is the contrasted account for depreciation, by $10. The second step would be to determine the net cash flow from operating activities, beginning with net income for the indirect method. The net income is reduced by depreciation expense, but notice that this expense is completely non-cash, because when you depreciate your assets, you're not actually paying out cash, right? Thus, to convert from accrual income to cash-based income, we have to undo the effects of all non-cash items, such as depreciation. Change in receivables and payables from beginning and ending balance sheets. The formula for calculating operating cash flow is net income plus depreciation minus changes in assets plus changes in liabilities equals operating cash flows. Also note that other refinements might be necessary to eliminate non-operating items. If, for example, the company reported a gain on sale of an investment. Now, step number 3 would be to determine net cash flows from investing and financing activities. Now, before we do that, we want to check off each balance sheet item as we go, and from the illustration in front of you, you see that we have dealt with all the checked items in the first two steps, and the only two items remaining are building and common stock. Notice also that there are no dividends in this example, so all the changes in the retained earnings item are from the net income. So we begin with PP&E, or property, plant and equipment, which basically covers the building item. And since we can see from our analysis that the building was or went up in value by $50, so we assume that $50 cash was spent acquiring the building, which we know explicitly from the description of the firm's activities at the beginning of the example. Note also that we are looking at gross PP&E, not net PP&E. So here are the formulas that you can use to calculate these items. So the beginning PP&E plus the purchases minus any dispositions would give us the ending balance for PP&E. The ending PP&E minus beginning PP&E would equal purchases minus dispositions. So we can basically swap this formula around. Now the second item that we did not check in the first two steps was the common stock, which falls under financing activities. So determine financing cash flows by examining changes in debt and equity accounts. In this example, we have only common stock. So in order to calculate the ending stock value, we need to figure out the beginning stock plus any issuances minus repurchases. The ending stock minus beginning stock will also equal issuances minus repurchases. So basically just swapping the formula around, or reorganizing the formula. The stock account in our example increased by $100, indicating cash was raised by issuing stock. Now you can see that all the items in our examination of the balance sheet items have been dealt with. Now, having completed the first three steps, this slide presents the statement of cash flows. This statement shows also step number 4, which is including the summary of net increase or decrease in cash, cash at the beginning and cash at the end. And also in this example, step number 5, which was disclosing any significant non-cash transactions separately at the bottom of the statements, is not really relevant because there was no significant non-cash transactions. So in this example, we only used step 1 through 4. Here we want to take a look at an alternative way to perform the second step, which was to determine the net cash flow from operating activities, beginning with each line item for the direct method. Now, to create the operating cash flows with the direct method, we need to work through each line item of the income statement. Here you see that there are credit sales of $100, but based on the increase in receivables of $10, one can tell that the company only collected $90 in cash. There was an SG&A expense of $40, but based on the increase in payables of $15, one can assume that the company only paid cash of $25. The depreciation expense is non-cash, so it should not be included. And if working from a statement of cash flows prepared with the indirect method, it is necessary to remove all non-operating items from revenue, the gain on sale of equipment, for example, and to remove all non-cash expenses from the expenses items. With this, we can create the cash flow statement for company ABC using the direct method, and included in the cash flow statement, you can see that cash from customers equals the sales, which was $100, minus change in receivables, which was $10. So that will give us the $90 in the cash collected from customers item. Cash to suppliers equals SG&A expense of $40 minus change in payables, $15, which gives us the $25. Now, if working from a statement of cash flow, as we mentioned before, prepared with the indirect method, it is necessary to remove all the non-operating items from the revenue and to remove all non-cash expenses from the expenses. So you can see that represented in the cash flow statement in front of you. It was mentioned earlier that it is desirable that operating cash flows are sufficient to cover capital expenditures, also known as fixed capital expenditures. So the excess of operating cash flow over capital expenditures is known generically as free cash flow. For purpose of valuing a company or its equity securities, an analyst may want to determine and use other cash flow measures such as free cash flow to the firm, FCFF, or free cash flow to equity, FCFE. Now, the free cash flow to the firm is the cash flow available to the company's suppliers of debt and equity capital after all operating expenses, including income taxes, have been paid and necessary investments in working capital and fixed capital have been made. CFO represents cash flow from operating activities under US GAAP or under IFRS, where the company has included interest paid in operating activities. Now, it is worth mentioning that under IFRS, if interest paid was included in financing activities, then CFO does not have to be adjusted for the tax. And under IFRS, if the company has placed interest and dividends received in investing activities, these should be added back to CFO to determine the free cash flow to the firm. In addition, if dividends paid were subtracted in the operating section, these should be added back in to compute the free cash flow to the firm. Now, the free cash flow to the equity is the cash flow available to the company's common stockholders. So after all operating expenses, including taxes, have been paid, and after borrowing costs, principal and interest have been paid, and after all operating investments have been made for fixed capital and working capital. Now, how can we compute free cash flow to the firm? We can calculate it or compute it based on the following formula. We start with the net income, and then we add non-cash charges such as depreciation and amortization, and then subtract working capital investment or working capital expenditure, and then we add the interest expense multiplied by 1 minus the tax rate. Then we subtract fixed capital investments or capital expenditures such as equipment, and that would give us the free cash flow to the firm. The reason for adding back interest is that free cash flow is the cash flow available to the suppliers of debt capital as well as equity capital. So these have the cash flow available to one of the capital providers, which has been deducted from net income, and for that reason it must be added back before we can compute free cash flows. We could also conveniently calculate free cash flow using the cash flow from operating activities, or the CFO, and in using that method, our formula would be the free cash flow for the firm equals CFO plus interest expense multiplied by 1 minus the tax rate minus fixed capital investments. The reason being is that CFO already has added non-cash items to the net income and deducted working capital investments. So this could make our computation a little bit easier. Remember that we said that free cash flow to equity is the free cash flow after investment in working capital and fixed capital available to equity holders only. So we can calculate that using the following computation method, which is to start with net income and then add non-cash charges minus working capital investments minus fixed capital investments, and then we add net new borrowing or minus net debt repayment. Now, a positive free cash flow to equity means that the company has an excess of operating cash flow over amounts needed for capital expenditures and repayments of debt. This cash would be available for distribution to the owners or the investors. Now we can move on to the last learning outcome of today's lesson, which is the use of performance ratios to analyze cash flow statements. Ratios based on cash flow provide information that help an analyst better understand the company's past performance, whether either trend or cross-sectional, and develop expectations about the company's future prospects. So as you can see on this slide, we have a list of several performance ratios based on operating cash flow, and in general these ratios measure the cash return relative to alternative financial items. So we have the first ratio of cash flow to revenue, which measures the operating cash generated per dollar of revenue, and then we have cash return on assets, and this one measures operating cash generated per dollar of assets investment. We have cash return on equity, which basically measures operating cash generated per dollar of owner investment. Cash to income, and this one measures the cash generating ability of operations. And finally we have cash flow per share, which measures operating cash flow on a per share basis. Now, if the company reports under IFRS and include total dividends paid as a use of cash in the operating section, total dividends should be added back to CFO as reported, and then preferred dividends should be subtracted. So recall that CFO reported under US GAAP and IFRS might differ depending on the treatment of interest and dividends received and paid. As an analyst looking at financial cash flow statements, you could also use coverage ratios. This slide here lists several coverage ratios based on operating cash flow, and in general these ratios measure the extent to which operating cash flow covered various of the company's expenditures and commitments. So we have debt coverage ratio, which measures the financial risk and financial leverage. We also have interest coverage, which is the ability to meet interest obligations of the company. Reinvestment ratio, which measures the ability to acquire assets with operating cash flows. We have debt payment, which is the ability or measures the ability to pay debts with operating cash flows, and dividend payments, which measures the company's ability to pay dividends with operating cash flows. And finally we have investing and financing, which measures the ability to acquire assets, pay debts, and make distributions to owners. That was it for today's lecture, covering chapter 6, which focuses on understanding cash flow statements. Thank you, gentlemen, for listening, and now I'd be happy to answer any questions that you may have. Thank you.